Hello, everyone, and welcome. Thank you so much for joining us today. Without further ado, it's my pleasure to introduce to you Zach Mans and Garrett Patton, senior analysts with ElliotWaveTrader.net. Zach is a co-host of their Stock Waves and Mining Stocks service, along with their weekly Beginner's Circle webinar for new members. And Garrett is a technical analyst and chief educator, focusing primarily on equity futures and demonstrating the capabilities of unconventional technical analysis. To our live viewers, please type any questions that you may have for Zach and Garrett into the live chat box, and time permitting, I'll announce those questions at the end of the presentation so that they may answer them. Now, with that all said, gentlemen, I'll hand the mic on over to you. So if you need anything, I'll be right here, but the floor's all yours.
Thank you, Charlotte.
Thank you very much for that introduction. My name is Garrett Patton. I'm here with my colleague, Zach, and we wanted to use this presentation time to give everyone a glimpse into how we do sector analysis in our Stock Wave service on the ElliotWaveTrader.net site. And before we jump into it, if at any point you feel interested in checking us out, we offer a 15-day free trial on our site. So head on over to ElliotWaveTrader.net and you can sign up with no credit card required. So the service that we focus on in Elliott Wave Trader, called Stock Waves, is obviously, as the name implies, focused on individual stocks. But we like to every week pick a specific sector within the common sector ETFs, usually the spider ETFs, where we go over the analysis on that specific sector and then do a deeper dive into the individual top holdings within that sector ETF to figure out both which individual stocks we feel have the best potential to perform or offer a good trade setup, and also get a better idea of how those individual stocks in their respective analysis either agrees with or disagrees with the overall expectation for that sector ETF. And along with those individual deep dives into individual sectors that we do every week on Thursday, we would actually be doing that right now instead of this presentation. We try to every month or so, every 4 to 5 weeks, take a look at the sector ETFs as a whole. So review all those individual sector ETFs, which gives us a pretty good read as far as how they fit within the broader picture, the expectation for the entire market itself, usually the S&P 500, and where there are opportunities to rotate into specific sectors that we believe have the potential to either perform better than the overall market, than the SPY or the benchmark, the S&P 500, or maybe underperform as areas to otherwise avoid. So I'm going to start off with the current chart that you see pulled up, which is a comparison of sector performance, the main larger sectors in the respective spider ETFs compared to the SPY. It's a little bit busy, but the dark black line here is the SPY, which year to date is down about 14%. And you can see there is one outlier, obvious outlier, which is the orange line here at the top, which is the energy sector, XLE, which has been the one sector that has maintained positive performance throughout the entire year, up about 64%. So obviously that has been a great area of the market to be in. We'll go into some of the specific calls that we've had at the beginning of the year, as well as earlier back in 2020. But you can see that the rest of the sector ETFs have generally traded in line with the SPY overall, which you would assume is going to be the case, just with varying different performance. Some of the better performing sector ETFs have been consumer staples, utilities, healthcare, the industrials, and some of the worst performing sectors have been technology, biotech, and retail. Those are the ones that are down closer to 20 to 25% on the year. So those have definitely been areas of the market to avoid in comparison to some of those better performing sectors, which are the ones that we've actually been focusing most of our attention on this year, especially XLV and XLI, as two ETFs that we've been looking for opportunities within as far as both trading individual stocks and those sectors themselves. So next up on the screen, you should see a post. This was from January 3rd at the start of the year. So we're going to start off with the energy sector in XLE. It has been an area of the market that we've been pretty staunchly bullish on since the low that was made back in 2020, especially coming off of the October low in 2020. And we did see a nice opportunity to post a couple of wave setups at the start of the year. As you can see, the first one is HES, as it was turning up from the low that was made in December, and embarking on that move that took it up into, I think it was into the 115 to 120 range. I think it took closer to about April in the chart here. It's marked as about March for that target for that pink wave 3, but a great opportunity that we alerted our members about as far as this wave setup to position in one of the names that we personally liked, which was HES. Had a nice LE wave setup to head up into that range during the first initial 3 months of the year. Same day, Zach also posted a wave setup for PDCE. It had a very similar setup. Obviously, a lot of the individual stocks are going to have a similar setup, given they follow the same overall movements of the larger sector in most cases. And a nice strong move to the upside for a $75 target when price was sitting at about $51 at the beginning of January. So we usually, again, when we dive into those individual sectors, we like to pick out some individual stocks that we like, both either based on their potential percentage performance or based on their large degree elite wave count that we have either the more confidence in compared to others, or maybe there's more history, so a large degree count to place that smaller degree count in context with. But I did want to also highlight how we were getting bullish on individual energy stocks back at the 2020 low in October. One of our favorite stocks at the time was EOG. That was one that we were more confident in being a 1-2 off of that earlier March 2020 low compared to other stocks that had the potential to be an A, B, and just setting up a measured move C wave to the upside. And the reason for that being that this is one of those energy charts that had a cleaner large degree LA wave count that really strongly supported that March low in 2020 being a cycle degree wave 4 and a 1-2 forming off of that low. So we were able to get our members into EOG at about $35 as price was turning up off of that October low. And as I'm sure many of you are aware, it has multiplied over many times since then, as far as the recent upside into the highs that we've seen so far this year in the primary wave 3. It's also a nice post to illustrate because you can see that one of the replies from Lynn Alden. If any of you are familiar with her work, she's a great macro fundamental analyst who we brought on in 2020 to provide us with some fundamental views to accompany our technical analysis. And she posted her fundamental take on EOG, where she was looking at the price to sales ratio, price to book value, as far as being very attractive in a basically aligning to that expectation based on the technical picture that we were seeing at the time for EOG to be putting in that bottom in October of 2020. So next up, I have a chart that compares the recent divergence that I'm sure many of you are aware of between the price of crude, which I have illustrated here with the USO ETF, the United States Oil ETF, compared to that XLE ETF, those individual oil and gas stocks. Recently, we've seen significant outperformance from XLE compared to USO, where the vast majority of the time, they're going to be much more closely correlated, as you can see from the start of the year up until about September, October time. So we personally believe that rather than seeing USO catch up to where XLE is and close that gap by seeing crude oil head significantly higher here to match that same performance from XLE, that instead we're going to see the opposite, where individual oil and gas stocks should get a correction here to come back closer into a line where crude oil is trading, close that gap to the downside. Based on our LE wave count from the 2020 low. So was highlighting EOG when we were turning up from the lows in November, October time, and the start to the large degree third wave, which we believe topped earlier this year back at about June, April time, depending on the individual chart. We did get an initial pretty decent decline. I think it was 20 or 30% into the July low, and since have
30%.
rebounded from that low back up to retest the prior highs in the year. So based on our expectation from that LA wave count, we believe that the correction off of the high that was made back in June and April has not completed yet. That was, again, the top of wave 3, and price is still working on the fourth wave, needing another leg back to the downside as wave C of 4 to take it somewhere in the region of that prior July low before completing. And then from there, set up the final fifth wave. That should take us well into next year as a next pretty decent opportunity to position long on individual oil and gas stocks.
I think this is a good opportunity, Garrett, to go back to, go back to that chart with all the sectors. Because one of the things that we've talked about for our members is how, particularly with regard to the energy sector, is that a lot of these energy names, they are closely correlated at times with a commodity. But as we looked at, sometimes that gets skewed or falls out of phase. And if you look more closely, all of these sectors, for the most part, follow a very similar shape. Sometimes there's some nuanced differences there, as Garrett was saying, that we can look at and get some clues. But if you were to zoom in to just the structure off of the October low, you'd find a lot of similarity where it looks like those energy names just kind of got sucked up and pulled along with a bigger corrective bounce that we saw off of the lows. And if you really look at the structure of the individual subwaves off of that October low between those different sectors, you'll see a lot of similarities and overlap there, even if the magnitudes are different.
Right. So the next sector I wanted to focus on is XLV. Mentioned at the beginning of the webinar that there were some specific sectors that we came into this year favoring more than other individual sectors. And even more recently, there are a few sectors that we still believe have the potential to see further upside, new highs next year. And XLV is one of those, along with XLE, which we were just looking at, although again, we want to see that C wave down within the water flat wave for. Actually kind of interesting here that I have XLV pulled up, and it has a very similar look to it as what we're currently looking at on the XLE chart, as far as the third wave, in this case, complete back in, September of 2021, and then a B wave bounce into the high that was made at the beginning of the year, and then setting up a turn back down as that C wave to complete the water flat wave 4. So this is a chart from back at the beginning of the year, but it's actually a similar look to what XLE seems to be supportive of right now. So even though we've been bullish on XLV going into the year, we were expecting some initial downside to take price back somewhere in the vicinity of those lows that were made in October of last year, basically retesting this prior A wave low before trying to turn back up in the start to that fifth wave. And one of the individual stocks, again, I mentioned that we'd like to, after looking at the specific ETF, dive into the individual stocks and holdings and pick out some of our favorites as far as trade opportunities for our members. One that we've been particularly bullish on and has been very kind to us is Cigna, CI, which, as you can see here, was posted as a wave setup at the end of January as price was coming up off of the lows at the end of last year and what looked like the start to a wave C of 3. So we used the opportunity for the pullback that we were getting in at the end of January into early February as an opportunity to attempt a long position using a stop underneath that November low, trading for the potential to head up into the 300 and beyond region as the wave C of 3. So a nice individual setup that we had there based on our analysis of the XLV chart. So this is a up-to-date chart now as of today's close for XLV. As you can see, we did get that turned back down following the high at the beginning of the year as the rest of that C wave. It did stretch a little bit past some of the prior lows there, but nice recovery since that. Looks like it is on track to still get that higher high next year as wave 5, getting actually pretty close to a higher high compared to some of the highs that were made earlier this year. The near-term expectation for us, though, is that rather than seeing an immediate sustained breakout above those prior highs to head to the blue box in a direct fashion, ideally we get a near-term corrective B wave pullback first that can more than likely not come back to retest some of the moving averages that are grouped at about 130, somewhere around that range before turning up for that final C wave into the blue box, heading up to about 150, maybe 165. And Zach was talking about the performance of some of the individual ETFs off of the more recent October low. And this is a list of the ones that within our service we picked out as some of our favorites as far as the potential to perform better than others in that expected turn up off of that October low. One of the best performing sectors has been SMH, the semiconductor sector. We also liked XLI, as mentioned earlier. XLV has performed well. ITA is another area of the market that we think can be positioned for a higher high next year and doesn't necessarily match the exact same count as the larger degree market. So ITA, I was just mentioning, this is a chart from the end of September as price was coming into the bottom, the recent bottom that we just saw as far as the October lows in the broader market. As you can see, the expectation here is for price to turn back up in a C wave and eventually head to a new high next year with at least 129 as the minimum expected target. So we've already gotten a decent reversal off of the low that was made in October. Similar to what I was showing you on the XLV chart, though, rather than an immediate sustained breakout to new highs, we believe we can see some degree of consolidation around this region to take price back to, should have an updated chart here, maybe not. Back to the $105 to $100 region before that sustained breakout to new highs is seen. And actually, based on the size of the upside that we've seen from that October low.
Still showing the September chart, Garrett.
Right. This is okay. Illustrating when it was coming into the bottom of that October low. Gotcha. Based on the size of the upside we've seen from there, it seems like we actually could be targeting higher than 129, maybe up into the next higher fib you see there at the top of the screen, this 1236 at 147 before this wave CF3 completes, if this is just the initial wave 1 start to that C wave. And as mentioned, SMH was another area that we thought could see some decent outperformance as it was approaching its respective low. As you can see here, this was a chart posted at the same time. I pulled these two charts from one of our sector review videos, where again, we go over all the individual sector ETFs and our expectation for them individually. So we were looking for price to approach a similar bottom here, looking for a little bit further downside. We did get that closer to about 170 to complete this blue A wave. And I've seen a nice 25% bounce off of that October low, what should be the start to this B wave, which we believe is just the initial A wave so far within that wave B. Zach, did you want to take a look at some of the other ETFs, maybe XLI?
Yeah, we can do that.
Pass it over to you.
Here we go. So as Garrett was saying, XLI is one of the other areas that we do think has a decent chance of trying to make a higher high. But since we know that a lot of times the pull from all of the indexes as a whole is sometimes going to affect even the best looking chart setups. So even though this held significantly higher relative to everything else, I have that path for an ABC up to a higher high that we're looking at on, say, XLV. as a purple alt here. And that the more concerning thing that we see at the moment is that this could have been all of the top there, like we are counting in the broad market and some other things, and that we've already come up to a 764 retrace, depending on whether you count this as all of the A wave down, the initial move down from those highs, or if you count it into this low and count a wider flat here. So either way, XLI is one of the things that runs risk in the short term of being more bearish than a lot of things. But if it can hold the same B wave retrace, even though a lot of things were looking for just this A, B, C of the wider flat, that because it's already come up so much and it does fit with that XLV potential, if we see that really nice corrective retrace into support, holding here that we're looking at for most things, then this is one of those areas where instead of just getting a C wave up as part of that corrective flat and then turning down, it can surpass that and outperform. Another area of concern, though, that we had mentioned is that we saw relative weakness in a couple of things, XRT being one of them, and XHB is one of the areas that we are also concerned. I think this is the housing sector ETF, right, Garrett?
Yeah, builders, yeah.
Right. So similar to XLV, it did not actually make a lower low in October. So we knew that we could expect a decent bounce, but the move down into October did look more like a potential 5 waves after a B wave that already completed from that very significant top. I have the red 5 here is not showing as an alt, it's just adding a lot of emphasis to the fact that this can be a lot more immediately bearish. So off of that high in August, we have a potential 5 wave move down as the start to this larger intermediate degree C wave that I have in red for emphasis, and so far a corrective 3 wave move off that low. It does look like we're getting a little bit higher in this wave 2 here towards that 64 region, but as long as we're going to hold under the 68 level, between 64 and 68, there is a much more immediately bearish setup in XHB. So we did post this as a recent wave setup for our members, saying that if we're looking for a corrective consolidation, a lot of things, but here's something that instead of being an A wave up and getting a B wave consolidation, could potentially drop much more severely. Now, if this is the wider flat in yellow that would rhyme a little bit more with a lot of the other sectors, then maybe this initial ABC move up off of that low is the wave 1 of a more choppy ending diagonal for the yellow C wave. But again, that would strongly rely on it holding into the 56 to 55 region when everything else is getting that B wave retrace, and it runs the risk of dropping more severely than that.
Another area that we do think can perform very well next year is precious metals miners.
And we are looking at this entire consolidation, which I know GDX was not one of the things that we included in the view of all of those ETFs together. A lot of times it, even more so than probably the energy sector, GDX is probably more closely tied to the precious metals commodities. But those have filled out a very, very large corrective consolidation that got to about a 764. So it's the lower side of what's a reliable retrace for this larger degree A wave and B wave consolidation off of the 2020 lows. But a lot of the individual names that we follow very closely in our metals, miners, and agriculture service, which you can add to stock waves at a 50% discount at EWT, a lot of those did hold relatively higher supports. So we're looking at an initial move up off the low that does look very similar to a lot of the other sectors off of the September, October lows that so far is only 3 waves up. So we are due for some consolidation. It's not clear yet if that's going to hold a 4th wave and then get a 5th wave up for a little bit smaller version of this wave 1, or if that's going to fade a little bit more as a wave 2 and then get a 3, 4, 5 up for the larger wave one here. But we are looking at this as being just the very start of a longer term swing, as long as we can hold corrective support in the mid 20s.
All right, do we want to do some questions now? Last 5 minutes.
All right, absolutely. We do have a couple of questions in the chat. So let's start with this one from John asking, what is your expectation for oil stock and ETF performance over the next 12 months?
Was that a specific ticker, or was that the XLE in general?
XLE in general, I believe.
Okay, so as Garrett was showing, we would like to see, there are a couple of charts where this counts better at this point because it's gotten nominally higher as an alt version of the 3, 4, and 5 for this top. So instead of getting just a C wave down of the wave 4 back into this 60 region of support, they might need a new ABC move. But we do expect most of those energy names to try and get some decent consolidation back towards the lows that were seen in July, if not even lower. And then after that's complete, we would be looking for a larger ABC move up to new highs, which ideally gets most of that in 2023, some of that depending on how long it takes to get down into our support region. This move might take longer, a little bit more into 2024, which would be some really nice divergent strength that we could see from the energy sector that could be a safe haven when the rest of the market is having some more difficulties.
Thank you so much. Before I forget, we did also have Norman in the chat asked if you could please go back to the EOG chart again.
I'll have to.
Yeah.
You'll need to elaborate a bit on that. Okay, so Norman, if you'd like them to go back to that chart, if you could please elaborate a little bit more. And we have another question from Hardik asking for your thoughts on IBB. They said in parentheses, biotech, the ETF chart.
We usually we try and stick to XBI a little bit more. And we are, again, that was one of the areas where it did not make lower lows in September and October. So it was retaining some bullish potential, but it really did not move up as aggressively with a lot of the other things, choosing instead to fill out just the rest of this smaller leading diagonal. So we are looking for more of a corrective retrace from here that needs to hold the September lows. Really ideally holding in the 77 region. And then if that can hold, then it can be more immediately bullish. This doesn't really look like this B wave for a larger version of this parentheses B because it did get a 5th wave up in that leading diagonal manner. But it's not the cleanest chart.
Thank you. And they did say and XBI. And Norman has elaborated on the EOG chart. He said, it's the EOG wave 5 target. Does that help at all?
So that wouldn't show up on the chart that I had if you want to just pull up yours, Zach.
Might have the right tab. That's there you go. Okay, not so bad. I have to zoom out here to get to the wave 5 target. Delete that random 2 that sometimes gets placed there. So again, looking for similar relative support to the other area of that wave 4 that we're looking at in most other things. At this point, maybe it stretches out into March or April because it's lingering here at the top. But then normal resistance for that 5th wave from there. Again, it would need to be an ABC move because the wave 1 and the wave 3 all subdivide into ABC moves. So after this completes, we'd be looking at an ABC move up, at least to the next fib, which is around 175, possibly even another fib beyond that, which is closer to 215. And that when you get the subwaves, once you start to get most of your A wave in place, and then you can draw your ideal fib retrace zone for your B wave, and then you can more accurately project, where that C wave should target. But yeah, that 170s to 210 region seems to be a pretty good target.
Thank you. And are you able to provide any analysis of Range Resources? The ticker is RRC.
We do cover the individual energy stocks extensively, including RRC in the stock waves service on EWT, but we were mostly just focusing on sector ETFs for this webinar. But it's the same expectation. We don't believe that the fourth wave correction there has completed yet.
A lot of those smaller ones, even though they seem like they should be more tied into the movements of natural gas, a lot of those trade more in line with XLE and XOP as maybe the smaller cap exploration energy names. And this looks even more like the B wave making a divergent lower high than it did in June as our B wave there.
All right, everyone, that does conclude our time for this session. So another huge thank you to both Zach and Garrett for a fantastic presentation and for answering the audience questions that they were able to. And those of you in the audience, thank you all for joining us for this virtual event. We do appreciate you at the Money Show, and we hope to see you next week, December 6th and 7th, for our Money, Metals and Mining Virtual Expo. I hope everyone has a wonderful rest of your day.
Thank you, Charlotte.
Thanks again.